Good evening, everybody. Thanks for tuning in. We're going to do a little pre weekly SPY preview. Now, I spent more time than I care to remember in the institutional trading world. And let me tell you something, it's not as mysterious or as exciting as you may think. I hear all this stuff about, oh, former hedge fund trader this, former hedge fund trader that. Well, guess what? I oversaw the trading of, I don't know, maybe 15 different hedge funds. As an institutional trader, I oversaw the trading of various mutual funds. So I've been around the block, and let me tell you this: just because someone's a former hedge fund trader is not a big deal. Plenty of hedge fund traders lose money. It's like saying, "Oh, someone's a doctor." Okay, oh well, you're a doctor. Did you like save people's lives, or did you have like incompetence and got sued because you accidentally killed people? It's like big deal. But anyway, I just want to expose some of the myth. So one of the first things I would do with my investment team on Monday mornings is we just go through the sectors and just see like what looks like it's going to move. Maybe this will move. Maybe that's not going to move. If this looks like it might go up, this sector, maybe we look for stocks within that sector that might go up, so forth and so on. So I'm going to start out with the S&P 500. We're going to look at the SPY. You might have heard of SPY. The reason why we call it SPY is because the symbol is SPY. And this is an ETF that tracks the S&P 500. S&P 500 is the most important benchmark on Wall Street. It's what most funds compare their performance to. You got to have a benchmark. You can't just give someone money and be like, okay, well, let me know. You got to be able to say, oh, you did better than the benchmark, you're doing a good job. You did worse than the benchmark, you're doing a bad job. In other words, if the S&P 500 is up 10%, you're only up 5%, you're doing a bad job. If you're up 15%, you're doing a good job. Now, so here's SPY. Here's our ETF, S&P 500 ETF. And let me just kind of clean this up. And what I'm going to do tonight is I'm going to just kind of go through my charts here and clean them up and get them ready for the week. And hopefully you'll check back. This is the secret to making money. It's not having some like visionary weird system and let me just put right out there, like things like Elliott wave and Gann theory and Fibonacci. No one in the institutional world pays attention to that stuff. That's just fiction. Okay, there's no such thing. Well, I mean, maybe there is, but whatever. But no one who I ever met who knows what the hell they're doing talks about Gann theory or Fibonacci or Elliott wave. It's just fiction, man. It's like it's like astrology or tea leaves. But what we do is we pay attention to what are important price levels, what's the momentum, what's the psychology, what's the trend. Now, notice how here's SPY, it stalled out right at 450. Why did that happen? Is it because of it's a Fibonacci this or that? No. It happened because one, people like nice round levels. I mean, how many people say, oh, gee, sell my SPY if it gets to 447? They say, oh, if it gets to 450, sell it. Notice who here too how back in April of last year it was like a little bit of a top here. See, markets don't go in straight lines; they go in peaks and valleys. See, peak, 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 and there are people who bought back here who regretted doing so because once they bought, the prices fell off a cliff. And a lot of these people tell themselves, "I made a mistake. I want to get out of this position, but I'm only going to do so if I can get out of break even. So if it gets back to the price where I bought it, I'm going to sell it." So as a result, you have these remorseful buyers placing sell orders at a level that was resistance. So if you have enough of these remorseful buyers placing sell orders, the level becomes resistance. So it's not a surprise that we just jacked up here, ran into 450 and hit resistance. All right. So this week, when I'm watching the market, I will be paying very close attention to what goes on here with SPY, the S&P 500. Generally, when a market gets to an important resistance level, there's some kind of selling pressure. And the reason why that happens is because, as I mentioned, there are people that want to sell if it gets back to that level. But there's some investors who are thinking about selling and they're watching it and they're watching the uptrend. Let me put that uptrend in here. And the traders who know what to do are waiting for the market to tell them. They don't guess. Okay. They just react to what the market's doing. If you come in every day with a preconceived notion like, oh, I'm going to do this, I'm going to do that, you're going to have your ass handed to you. You got to let the market tell you what to do because the market's never wrong. So we have investors who are watching this go higher And all of a sudden they notice, oh, it's not going higher anymore. Why does the market go higher? Well, the market goes higher because there's not enough supply or sellers to fill all the demand, aka buy orders or buyers. So the buyers are forced to pay a premium to entice the sellers. When we get up to a resistance level, all of a sudden there is enough supply. Remember, when you look at a chart, you got to look at through the context of what does this tell us about supply and demand? What does this tell us about psychology? If you don't do that, you will never be able to understand what these charts are. I promise you. I've been doing this for a long time. People are like, oh, you chart guys, you're astrology people, you're tea leaves. Well, I guess, yeah, for a lot of people they are because they don't get it. But if you understand psychology, all of a sudden this becomes, I don't want to say easy, but logical. Okay, so let's go with logical. Now, we hit resistance because we were at a former peak. Investment psychology, buyer's remorse created resistance at a level that was resistance. Look at this here. This level here is 431. Notice how resistance over here became support. Well, this is seller's remorse. People sold, price goes higher, and a lot of them tell themselves, man, I made a mistake. If the price comes back to where I bought it, I'm going to buy my shares back because I want to buy my shares back, but I'm only going to do so if I get them for the same price I sold them at. So resistance can convert into support because of seller's remorse. Now, let's go look. So for SPY, we're watching the 450 hit level. How does this navigate? Does it blast through it or does it reverse? Either way, there's going to be trading opportunities. Now, if we go to the SPY fact sheet here, SPY is a SPDR, a Standard & Poor's Depository Receipt, run by State Street Global Advisors. So if you type in the symbol in SSGA, it'll bring you to the fact sheet. And let's just look at our various sectors. So technology is the biggest sector, healthcare, financials. Different sectors are in the driver's seat at different times. Over the last week, the market's been pretty darn easy to read. It's been all about the financials. And I'll get to them in a few, but we said if the banking industry holds up, that's going to propel the financial sector ahead. That's going to bring the market ahead, and that's what's happened. Until the month leading up to a week or two ago, it was the tech sector that was in charge. So if you focus on these different things, it's like what's going on underneath the hood or what's going on behind the scenes. Different sectors run the market at different times, and if you get an understanding of this, it helps you understand which way SPY is going to go. And I'm not going to get into tonight just because of time, but if you want to know which way a sector is going to go, you start looking at the stocks within the sector. For example, financials, biggest company is Berkshire Hathaway. Second biggest is JP Morgan. You want to get an idea what's going on with the financials? You check that out. All right, well, maybe we'll even look at it. All right, so biggest sector is tech. And I'm going to bring up the tech ETF, the tech SPDR, that's symbol XLK. And look at this. Wow. It is just a lesson. It's chock full of lessons about price levels. All right. I'm going to, get rid of that just to make this easier to read. And I do this every Sunday night. I go through my charts, I update them, I look at where the levels are. Now, notice where the tech sector ETF hit resistance. 177. Look back here, December of 21. So we're talking 18 months ago. A lot has happened in 18 months. Interest rates are different, oil prices are different, but yet somehow this sector ran into resistance at the exact same level. And I'm talking within a point. When I say exact, I'm not exaggerating. All right. This is a sector that's worth trillions and trillions of dollars. And yet somehow we ended up with this important level 18 months later. If you, like I said before, if you look at the market through the context of psychology, it makes sense. You have people who bought back here that want to get out at break even. So you got these remorseful buyers, placing sellers. Once again, we've run into resistance at the same level. Now, a fundamental analyst could never explain this. Oh, well, the price to earnings ratio is this, the price to sales ratio is that. Forget that. If you want to trade, forget about all this fundamental stuff, okay? Trading is about understanding psychology of the market, and it's about understanding your own personal psychology. Most new traders lose money because they guess, they get emotional, they overtrade, they feel like the overtrading is like you feel like you always need to be in the markets. The best traders can look at their psychology and say to themselves, what did I do wrong? What did I do? What did I do right? The best traders have self inflection. They don't go out there and be like, oh, it was the algorithms ripped me off, or the hedge fund people or market makers. Someone starts telling you like, oh, the market makers ripped them off. Don't even bother talking to them. I mean, I'm not saying don't be friends with them, but someone says, oh, a market maker ripped me off. They just have no idea how Wall Street works. They just don't. I was a market maker for 2 years. I can promise you this. I never once went to work where I thought, oh, how am I going to rip off the little guy? If you want to learn more about market makers and hedge funds, just check out on Market Lessons. All right, so buyer's remorse turns resistance into resistance. Oh, look at this. What another strange coincidence. This particular level is important too. And this is 164. It was support and it became resistance. Oh my goodness, how could that happen? Oh, look, support became resistance. Oh my goodness, how could that happen? Is it the evil hedge fund traders? No, it's market psychology, it's investment psychology. There are people who bought shares here who regretted doing so when the price went lower. They tell themselves, man, I made a mistake. If I can get out at break even, I'm going to. So they place their sell orders at the same level they bought at. If there's enough of these remorseful buyers placing sell orders, what was support can turn into resistance. That's exactly what happened here. You cannot explain this by fundamentals. You can't explain it by the debt ceiling. You can't explain it by tax policy. The only logical explanation is market psychology, investment psychology, buyer's remorse. Buyer's remorse keeps resistance. Once again, support turns into resistance. Support, resistance. Why are these levels important? I don't know. I don't need to know. Doesn't matter. I just need to know where they are. Do you know why the Maple Avenue is, put into a town at the particular place it was? No. But if you have a map, you'll know where Maple Avenue was. Now look at this. Resistance becomes support. Resistance becomes support. Resistance becomes support. Why is the 144 level important and the 135 level important and not 139 or 138 or 141? I don't know, but I don't need to know. All right. Resistance becomes resistance. Do I make myself clear? It's about knowing where these important price levels are. Resistance becomes support because of seller's remorse. People sell, the price goes higher. A lot of these investors say, man, I made a mistake. I want to buy my shares back, but I'm only going to do so if I get them for the same price that I sold them at. So if you have enough remorseful sellers placing buy orders at the level that was resistance, it becomes support. Levels. All right, so that's the tech sector. We're going to go look at the healthcare sector, which is the second biggest sector. Not kind of too much going on here. Don't let the scale fool you. This thing has been in a pretty much a 2-point range for, going on a month here. Here's what we got to watch going forward. I think this is really probably the most important sector to pay attention to. And this has been in the driver's seat for a while. Okay, let's just check this out. Support became resistance. Wow, how about that? For some reason, the level that was support in December of 22 became resistance in April and became resistance in June. How could that possibly happen? Is it because of the guru on CNBC is talking about? No. And watch out for gurus. They're a dime a dozen on Wall Street, all right? You got to understand when you look at a chart, you're looking at a graphical illustration of investment psychology. If you can't do that, you might as well just pack it up and go do something else. If you can do that, or maybe it takes a few months for you to get the hang of it, you're going to be successful, or at least it'll be a step in the right direction. 3350 is an important level. I don't know why, but it is. Now, within the financial sector, I think what we really got to focus on is the industry of banking. You have your sectors are at the top of the food chain, I guess, or the umbrella. Okay. Then within the sectors, you have industries. Now, I think the most important thing to watch this week and maybe going into next week is how does the banking sector do? And we got a lot of our banking earnings. They were pretty good on Friday, but lo and behold, we were down almost 2%. Now, here we have the banking industry for 3 years. We got resistance way back here in August of 20. We sell off during the banking panic a few months ago with Silicon Valley and First Republic, where do we find support? The 35 level, the same level that was important 3 years ago. Okay. It's what we call market memory. Resistance becomes support because of seller's remorse. There are people that sold back here, even though it's a couple years later, they still have that market memory. So support became resistance, resistance became support. Now we tested this resistance on the upper side here. Why would a level that was resistance, why would a stock get to it and sell off? Well, because you got investors who are watching it go up. They notice, oh, it's not going any higher. There must be new sellers coming into the market. So I don't want to miss out. So I'm going to reduce my price to sell at because the buyers are going to go to whoever's willing to sell for the lowest price. So you start to get the sellers to undercut each other. So when we get to resistance, a lot of times we sell off, and it has nothing to do with the debt ceiling or the balance sheet or this, that, or the other thing. It has to do with psychology. Looked like it was going to break out. You got a lot of sellers like, oh, these look like good prices. They start to undercut each other. You get a snowball effect. Same thing as when we get to support. Investors are watching. There's people that want to buy. They notice the price isn't going any lower, so they assume buyers are coming to the market. And they start to raise their bids or the price they're willing to pay because they know the sellers are going to go to whoever's willing to pay the highest price. So then you get the snowball effect. We come off of support because of people that are anxious buyers. It's psychology. We come off of resistance because there are sellers who are anxious. It's psychology. All right. So these are what are important to watch this week. Thank you a lot. Make sure you come back and remember, it's market psychology. It's all about the psychology. There's no rational reason why the banking sector lost 2% of its value on Friday, other than the fact that investor perceptions have changed. As far as I know, there's no bank that blew up and their money burned, so forth and so on. Psychology. Just tell yourself that. If you can understand the psychology, it will not maybe guarantee success, but it will put you much farther in that direction than trying to use logic and be like, oh, well, this is up because of earnings, this is down because of interest rates, blah, blah, blah. All right, everyone. Thank you so much. Make sure you tune in tomorrow, and I will talk to you then.